Good morning once again, and I'm privileged to moderate this discussion today, and this is something I'm very excited about. So, I just wanted to begin with this question: should passive be the default allocation? So, let me start with Vishal because he runs both active and passive, and then I will come to your village. Yeah.
I think maybe if I may suggest, why the question itself? Because end of the day, if we're truly an investor-focused, customer-centric business, that's the customer choose. I think the debate has been passive versus active.
Yeah.
And I'm just wondering why frame it like that?
Why frame it
Isn't it
like
all
binary?
about greater variety, greater choice to the investor? And because of that, everyone wins. Because at one level, I think the debate started with saying, oh, passives are easier, simpler, low cost, and therefore the new coming investor is better served by coming to passive. Now, there's a lot of merit in that, right? But if I look at the behavior, actually a lot of behavior in passives today is largest of institutions, very sophisticated investors actually buying passives.
Yes.
And if the sophisticated investors choosing a passive for very good reasons, why as a manufacturer and as an industry should we get in the way and say, oh, actually that's either right or wrong? So the one size fits all debate, I think, is probably okay at a inception level. But I would argue that, and just looking at the size and scale of the audience today here, that we've moved on. The passive industry, a decade earlier, we would have that discussion about, is the Indian investor going to come up to passives? Is India an active market, etc.? I think a decade has told us, just the last 5 years, we've seen 5x growth in passives. So is the investor buying passives? Yes, absolutely. A lot of very old distribution friends, great to see you here, because 5 years back, the debate was, oh, should I even get into this space? Is it worth my while? Margins are lower. Commercially, it's therefore a more difficult proposition for me, etc. Great to see the ecosystem actually mature so much. And therefore, I would say, we just have to probably look at saying, how is the customer getting best served? And is passives an important part of that bouquet that we can offer? And definitely, I would say it has a lot of value, as has been demonstrated through the growth and variety that we now offer.
Okay. Said before, I asked you the same question. I wanted you to share with the audience here. I'm very interested in the BlackRock numbers because these are almost unbelievable numbers. What's the size of BlackRock globally?
So it's always dangerous for me to quote BlackRock numbers because they move around a lot and they're big numbers. So I will caveat it. Look, firstly, thank you for having me. Happy to be here. If we look at, let's say, end of last year, the numbers were closer to overall AUM was well over $12 trillion.
Wow.
Right?
Sorry, how much was it?
$12 trillion.
$12 trillion.
Assets under management for BlackRock. Over that number. And the passive business or the indexing business was over 5, I think close to 6, but roughly around 50%.
Okay.
Which is kind of broadly in line with also where, let's say, passives are as a US, at least in the US market. So that's the split that we're talking about here.
Okay. And as a fund house philosophy, how do you kind of work with both together?
Yeah.
Active and passive.
Yeah, and that is what you said is exactly the words that we use. It's active and passive. So it's not active or passive. It's not active versus passive. It's active and passive. And kind of adding to the thread that Vishal mentioned, the asset allocation needs to be the core of the discussion, right? So, and all of these are just building blocks for an individual's asset allocation. There may be many, many strong cases to have a passive fund as a core building block, and that could be dependent on market views. So you could say, okay, there's a certain segment of the market, and people are talking about that for a large cap, for example, where there's most of the efficiencies have been kind of realized, so the opportunity to generate alpha is getting diminished, which means, well, just get exposure to the market, and the best way to do that in a cost-efficient manner is through a passive fund. So that's one reason why someone might choose to have a passive fund in their asset allocation. Another one can be more investor dependent as well. So again, a new investor maybe just wants to step in and allocate to a passive fund to start experiencing what it is like to invest. So their asset allocation might feel more passive heavy to begin with. While a more nuanced investor, and I'm still talking retail, could say, well, I have let's say an allocation, but I'm in a different stage of my life, and I want more targeted outcome-oriented strategies. And that could be much more. That could be an active strategy. It could be an SIF. And these are new here, so they can also be an active part of the overall asset allocation. And then you have the institutional, really advanced investors that then come back to say, okay, I have way more access to investments, which is, I'm accessing private markets, I'm accessing real estate, infra, all these other access. So for public markets, I want to keep it really simple. I just want beta exposure, which is what's happening here. So I really think that the framing has to be around asset allocation and thinking about active and passive as different building blocks for this asset allocation. And that's how it's been approached at BlackRock, and that's how we approach it at Geo BlackRock as well.
Okay. I'll come back to you later. I have something to ask you following from that. But before that, Anirudh, how many indices do you have?
We have over 425 indices now.
Over 400. Now, how many of them have had passive funds launched using your indices?
Well, I don't have that number on the top of my mind. There are about over 495 passive indices which are tracking our indices. But I would guess that number would be somewhere close to about 200.
200.
Yeah, but I'm just kind of doing a very wild guess.
What would be the scale? What would be the amount of AUM which is benchmarked to your indices if we were to take?
So if you look at the total passive industry right now, the total passive industry is about $13.6 billion. We do not have the April number as of now, giving you the March number. So we have roughly about 73% of the overall AUM of that. So which is a little over 10 lakh crore.
Okay, great. So as a stock exchange, there are people who come in directly. There are people who come in through mutual funds. They come in through passives. They come through active. As a veteran of the business, how do you see this debate about asset allocation using passives as the core rather than active?
Yeah, I think, so I would say that, the debate is not only in India, it's a global debate. And more than the debate, it's like a trend. I mean, it's a fact that the passive industry or the passive investment is gaining momentum. And if you look at, like 2020, I think the overall assets under management for India under passive would be close to about it will be 1.6 lakh crore. Now that number has gone up close to about 14 lakh crore. There's a massive growth that we have seen in the passive investments. We have been tracking the inflow in the industry. I think of the last 7-8 years that we have seen. So 4 out of these 7-8 years, where the net inflow in the passive industry has been more than the net inflow in the active industry.
Oh, okay.
So, I think it is undeniable that there has been momentum towards the passive industry because investors are looking at passive industry.
Okay.
Now, why is there a momentum? Of course, everybody talked about there is an institutional focus that we have. Now, if you break down this entire passive industry today, so of the 14 lakh crore, roughly about 3.5 lakh crore is your index funds, and another 11 lakh crore, round about 11 lakh crore is ETF.
Yep.
Within ETF, close to about 85% is equity. Now, maybe a little less because we have commodities also, which recently surged a lot. Now, of that, close to about 9 lakh crore, which is in the equities, a large part of the money is coming in from institutions like EPFO. But if you look at the holding pattern of the passive funds, and if you see them, separately for ETF and index funds, there is a pattern that emerges very clearly. So what is that pattern? The pattern is, on the ETF side, about 20% of your holdings are actually from retail and HNI linked folios. But that's very different when you're looking at the index funds. The index funds, almost over 60% of the folios are linked to retail and HNIs. So I think somehow, there is a realization that actually happened, and which is in line with the global trend that we have seen in other countries as well, whether it is North America, Europe, as well as some of the Asian countries. A retail HNI, they are actually looking at passive as a asset allocation tool. I mean, the point that both Vishal and Sid mentioned. So somehow I think that phase that we had, where passive used to be a fringe product, which is, somebody will come and play with that and experiment with that. We have gone past that particular phase, and people are now looking at passive maybe as a asset allocation tool. And I think that's the trend which is likely to grow in the future as well.
Okay. Vishal, as the markets get more efficient, data becomes more easily available. Do you see the danger of active funds becoming more like commodities? Because the value add, SEBI is given very tight definition, so there is not much room for leeway. Earlier, earlier it was possible to generate alpha by, outsmarting the index and having small caps and etc., and large cap, the dominant portfolio. But given the tight definition, not possible. Given the fact information is available more easily to people, given the fact everything is becoming more institutional, active funds, will they become a commodity?
So I think, conceptually and theoretically, I would say the answer tends towards a yes. But that is also, I guess, coming out of, what we are seeing in developed markets over a very long period of time. Now, in that context, if I were to look at where India is in its own journey and development, when and how that will happen looks very far away for us to be able to foresee, at least from where we stand. See, keep in mind, many of us would have seen markets where, as a fund manager, you were really looking at an active pool of companies to invest from, being about 150, 200 as, the universe that you could choose, where you had the research and the depth and liquidity, maybe a decade back.
Yeah. Oops.
That went up to about 250, 300 stocks, which is where the bulk of institutional allocations used to be. Today, our small cap fund has a sort of portfolio size of that many stocks. Our own research covers 3 times that number of stocks. So that's our investable universe, right? And we are still scratching the surface, because when you look at the amount of development that's happening, the lot of the entire ecosystem of startups, which at some stage comes to public markets, I think there is a long runway available for active managers to still be able to go out and generate alpha. So yes, conceptually, as information becomes freer and all of these, etc., that's been a debate for the longest time, and it has been the experience for good reasons across many parts of the market. But I would think that in India's phase of development, our depth, liquidity versus potential, the total amount of public stock available for retail investors or funds to buy is still scratching the surface. A decade or two, you can easily see, and just given the pipeline of private equity money, which eventually will have successful companies IPO out and come to the public market, even that pipeline to me looks like a very rich, very exciting opportunity for an active manager.
Okay. Now, Sid, you've come from markets which have had a longer history. They evolved. They have scale. There's transparency. There's governance. And has that led to the equity funds becoming more like commodities? When I say active, or do they fund managers in many of the developed countries have the confidence that they'll outperform the indices?
Yeah, I think it's a very relevant question, given where we are in kind of the India's journey. I have a slightly different positioning here. I don't think it commoditizes active.
Okay.
I believe it raises the bar for active.
Okay.
The availability of data information is, yes, getting democratized, makes it easier and easier. So it makes it harder and harder to generate alpha. But to Vishal's point, you can still generate alpha. And what we have seen, firstly at BlackRock, in terms of that evolution, is moving more and more towards data-driven, systematic alpha generation engines has proven more successful. And I'll give you an example. So there is a franchise in BlackRock called Systematic Active Equity. Actually started over 40 years ago. So it's been doing data-driven alpha investing for more than 40 years. And the ability for that kind of strategy to start continuing to generate consistent alpha while other engines of alpha start diminishing has proven very strong. So now that business alone is nearly $400 billion at BlackRock. So that's just BlackRock. So there's others like Dimensional. There's so many other people that are doing this as well, right? So that part has really grown because through that style of investing, you're able to bring in a lot more data and insights into the investment process. So, when we translate that to India, because when we looked at the market, we said we should be doing that in India at Geo BlackRock. So we brought over that platform, and we have over 400 data sets on over 1,000 Indian stocks. So that's the volume that we have, let's say, as a starting point. Then we use the technology, we use the Aladdin platform, which is BlackRock's investment platform, to convert that data into insights. And then we have the fund management team that is not using, let's call it, an army of human researchers, because how much coverage can you get when you are looking at this bigger universe and that many data sets, but starting with let's say the machine provided insights and then making the decision. So it's not black box. It's not completely, automating the whole process, but it provides the fund managers with a lot more insights that they can then take action on. So you're now getting to a stage where even a flexi cap fund can have over 100 stocks rather than 30 to 40 stocks. So, and then you can try to generate alpha with smaller, more consistent bets. So that has evolved. That strategy has evolved in the US and in Europe. We're starting to see that come into play here as well in India, and that's why when we launched with a systematic strategy.
Okay. Now, Anirudh, as markets become more institutionalized, do you see your business growing? How do you see your business evolving?
No, I think we see our task absolutely cut out, right? Because there is a trend, as I was talking earlier. People have now started using the passive fund, so-called, along with other investment products as a building block of their portfolio. And there is a clear shift happening. So as a index provider, as a, idea generator, or as a, provider of strategies, I think what we are trying to do increasingly is to provide the asset managers, the asset owners, the investors, even the advisors with a framework that they can use to identify that which part of the market is performing how, and therefore depending on their need of the wealth generation, the duration that they're looking at, they should be able to intelligently go and allocate the assets. So I think increasingly it is going to be more of a question of efficient asset allocation rather than just going and picking up one random product. And when you do that, then you are not only looking at one or two, index ideas, then you're looking at a whole framework. I think companies like us will have to work very hard to build this particular framework at, NSE indices. That's exactly what we are doing. We are going very deep. We are looking at 500 investable companies. We are also looking at the liquidity available outside the 500 investable companies and trying to figure out what different strategies that we can build based on those particular companies. We are looking at those sector set up companies from a sectoral lens, and then again try to create a solid grid that people can use to allocate their assets across different sectors, cut that across by different sizes, and then you have got multiple factors. You can blend those particular factors along with this size and the sector to create innovative strategies. I think it's a never-ending process, and there's a lot of work that we still have to do in this particular work.
Okay, Vishal, as the market grows, passives will have one can safely assume, a higher share. Does that reduce the importance of star fund managers in the business? And also, a lot of investing is now being determined by algorithms, which is what Sid was talking about. So they've been developing something for over 40 years, which they've bought. So where does that leave star fund managers in the system?
Right. No, I think, so when I look at the passive world, I don't know if many in the audience like me may have started off this journey saying, oh, passives are really beta products.
Yeah.
If you want something which is not too complicated in having to choose a star fund manager who may go through their own cycles, etc., why do you want to do it? Just buy the market and therefore largely choose a beta product. There is no alpha creation in a sense that is dependable, and therefore you go to beta, at least save cost and keep it simple, right? So that's where we started. Then there came the next challenge, which is, okay, a lot of people came into the benchmark indices, the Sensex, Nifty 50, and then you found another part of the market doing much better and say, oh, actually I should be in mid cap or I should be in small caps. And then you said, okay, let's be in 500. So as you can see, our evolution has been very granular, very ground up, based on where returns were getting generated. And much as we would try as a community to say, look, you should not look at past performance and past returns, I think some amount of return chasing is still something that you see in the environment. So the new product pops up because that part of the market has done very well in the last 1 year, 3 year, 5 year, not because you forecast it to be as much. How many of us are able to do that successfully? So is the alpha chase gone away? I would say no. Actually, if you look at most of the development, even on the passive side, these are very, almost, if I can call it, very unique but very sophisticated strategies. We had factors coming in. After broad-based funds, we went into sectors, and now we have factors. Now we have combinations of factors. And we have combinations of factors within a market size.
Yeah.
So it's no longer the simple slam dunk product where you say, oh, actually, if you're confused, just buy an index fund. Actually, it's come to the other end, which is very sophisticated, which is fundamentally driven by the need to outperform the market. So in one sense, I would say that you now have a highly sophisticated quant-based way of outperforming the market, largely implemented through factor funds and combinations of factors, Anirudh and team must be working on, often generated through market feedback, fund managers, economists, product teams, etc., germinating an idea and saying, why don't we do this? And this looks interesting. The beta market, I think, like Sid said, is the other almost polar opposite, which is the large institution, someone saying, look, I really don't want to chase alpha. Let me just buy the broad-based index and sit tight. I would put it as those are the two extremes of the market right now. Now, therefore, is the active manager, I might argue that, actually it's whoever generates alpha becomes the star. It could well be the one index or the one factor, which is today the star. It just doesn't have a name.
So the person might get substituted by an index.
Right. So sometime back it was momentum, which was the star. Right. It's not a fund manager, but that's who the star was. Today I might argue its value.
Good.
Incredible performance relative to other factors. So value is the star. So it's still the star in a different package.
Okay. So the star keeps changing shape. Okay. Sid, when you have so much of an algorithm-driven AI being used so intensively, who are the people that BlackRock projects if you were to have a roadshow? Who are the people who front the discussion?
Yeah. Look, people are very, very important. So when we think about the overall setup at BlackRock and Geo BlackRock for that matter, it's process, platform, and people. So it's all three. So it's not about the star fund manager. And given how I explain what we're doing, you can see how that is not something we rely on, but it's the combination of all three. So we 100% have, very, very experienced fund managers. We rely upon them. They have to make the ultimate call. So when we go and talk about our product, it's still our fund managers, our CIOs that are going and talking about it. We don't put, a AI chatbot on a stage, right? So that's important. But what we want to make sure our investors realize is that we value the combination of all three, so that it is not dependent on a single human being. You buy a fund because you like that fund manager. What happens if they leave? Do you need to now sell the fund and buy the fund of the other AMC that they're going to? Are you going to take that hit? Are you going to take the tax hit of doing that? We don't want to have that. So we don't want to have that dependency, and that's why we set it up this way. As an evolution, I do think that this maybe moves away from the fund manager being the star to actually the advisor being the star, right? Because we talked about asset allocation becomes the most important thing. So yeah, it could be this factor, it could be momentum now, it could be value tomorrow. So the person that is ultimately mixing and matching them correctly for the end client actually ends up becoming the star rather than the person that's generating the alpha, because it's not all about just the alpha on one fund. It's about the overall whole portfolio return. So I think that's where we could be going.
Okay. So the Sid is making a point that instead of fund managers, you become the stars because you are helping the clients do asset allocation. It's no longer the star fund manager who's the hero. You are the hero. Okay. Now, if that were to be the situation, what would it mean for the distribution business as such?
No, I think, look, Andy, there are two things on the distribution side. I guess, again, I would say that if we have to look at the trend, what has actually happened in other markets, the trend is very clear. I think people have systematically and consistently moved away from a kind of a distribution-led model to more like advisory-based business model. I think there are studies. I think one of the very important studies which everybody refers to, that is your Vanguard Advisor Alpha study that they do. And I think that's very clear that while there are people who have been, systematically been able to change and pivot their model to more engage with the investors in terms of taking decisions for asset allocations, and they have consistently been able to generate, alpha for those investors. And I think those are the people who have, been able to grow along with the investors' AUM over a period of time. But traditionally, the model that we have, whether it is a bank-led or individual distribution-led model, where the model was primarily dependent on, fee income based on commissions or distribution-led income. So that model has come under pressure, a lot of pressure. And it's not only one country that we're talking about. You look at what happened in the US, you look at what has happened in Canada, you look at what has happened in the UK, even some of the Asian markets like Australia or even Korea, more or less everywhere we have seen a similar kind of trajectory. So the data, if history provides any evidence to you, that data suggests that, okay, fine, there is a trend which is basically taking up.
Okay. Now, one paradox about passive funds is that what is the role that they play in governance? Because if passive funds have to be invested in the proportion of the underlying company and all that, what happens to corporate governance? Who is going to vote with their feet? Who's going to tell the management that, look, we don't favor your policies, your labor policies, your human rights, your consumer this thing or environmental? Who's going to be doing that? Because you don't have a choice. Whether you like it or not, you're stuck with that company. It's in the index. You can't do anything about it.
No, I think the question is slightly different in my mind. I think, look, again, if you look at the pattern and why investors lost money in the over, I mean, there are studies.
Yeah.
I think most of the time investors lose money because of timing.
Okay.
There are other critical decisions that they have to take, which could be even linked to taxation benefits that they can draw in from their investment decisions. Or, like we are talking about multi-asset allocations. But again, then what is the proportion of this particular allocation should be? Now, I don't think that every investor is capable of taking those particular timely decisions on their own. And therefore, what we have seen that in other markets where
Anirudh, I'm talking about corporate governance. So if a nifty company has, let's say, very poor environmental governance standards, what happens? Do the fund managers have the freedom to exit? Because in passive funds, you are married to this stock, whether you like it or you don't like it.
No,
what happens to corporate governance then?
No, I think the passive funds has got different kinds of passive funds as well. Of course, you can always go and look at a broad market indices, but then you can also include factors. Today, there are ESG factors which have been embedded into the passive funds as well.
Okay.
So if there are investors who are more concerned about the corporate governance or any other social aspects of a particular company, they can always go and choose the right set of products. Again, I will go back to my same point. If that is a concern that I have as an investor, then I need to sit down with an advisor and try and discuss this particular concern. And hopefully the advisor should be able to help me choose the right kind of product, provided that particular product is available in the overall framework that I'm working with, to pick up that particular fund and the strategy.
Okay. At BlackRock is easily the largest shareholder in the world. Okay. How do you manage this role of being the custodian of the, right values of the shareholder finally?
Yeah, I think it's a very relevant question. So, firstly, there's two, let's say, paths, right? So one is in the more traditional active funds. You know how it works.
Yeah.
Within index, it's not that just because it's passive that there's no line of sight on the corporate governance. It's a very, very big focus area. There's local teams that'll do it. There's obviously the proxy advisors that are doing all the research work. Once the actual, let's say, work is done and there is a view, there are still ways in which that can be affected, right? It doesn't mean that, okay, we've discovered something, but just because it's in the index, we have to ignore our discovery and continue.
Yeah.
We can engage, and we do engage with the index provider.
Okay.
So we can go and talk to them and say, hey, this is XYZ name, is this holding in your index? Here's the research that we've done that gives us these concerns. How should we treat this holding? Like, is there a way that you can actually, either phase it or take action from an index perspective as well? So I think that level of engagement between asset managers and index providers is very high globally. And I think that is a good level of engagement that we need to have around, and it extends beyond, like, it's corporate governance, it's market liquidity. That's another kind of big area which comes into focus once these funds get very big. So there is constant dialogue and communication between asset managers and index providers on these topics where we can address these. So it's not that you can only affect it through an active fund. You can still do it through passive as well.
Okay. Vishal, this audience is largely the audience here is largely distributors. What would you tell them about how do you build a scalable business around passives?
So first thing I would say is that build your scalable business around your customer, and passives will be part of that bouquet that you offer or the package that you offer on its own merits. So approaching it saying, oh, I will only do passive, only active, etc., that itself may be an opportunity lost in a sense. Now, if you are doing it with the customer at the center, and I think I'm, like I said earlier, delighted to see a very large part of the MFD distribution community being here, because that itself is telling us that we are beyond the first debate about should I or should I not. So, the fact that we have so many distributors here to me is telling us, yes, you've decided that this is a integral part of what you should be offering for very good reasons. Simplicity, lower cost, it's what does very well for the customer, etc., etc. Now, once we are past that and you've decided to be here, to my mind, and I think Sid put it very well, actually, you are the star. From a manufacturer standpoint, you are the chef. We're just providing the ingredients. And it's not the ingredients and a star ingredient that makes the dish, it's you. So the focus on how you're going to combine the range of passive products is going to be critical. And I think we started, like I mentioned earlier, with the premise that, index funds or passive funds are very simple, it's a slam dunk, it's very easy. But actually, as we stand today, I understand we have over 700 passive funds. So it's no longer just that, you pick one and go with it. It's an extremely dynamic world. It's probably as, if not even more dynamic than the sort of categorized active mutual funds that we have now. So there's a lot of innovation, a lot of action in this part of the world, and therefore the ability to add value, because you have just so much creativity, ideas, etc. coming through new packages. So actually, it increases the responsibility and the role that you have. It doesn't reduce the complexity in a sense. I would argue it increases it, because earlier you were just dealing with maybe, I'm choosing 5 categories of active funds and I'll choose the 3 best managers there, and there you have it. Actually, there is a lot more for you to do. So life's got even more exciting for you. Congratulations. It's allowing you to truly differentiate your value, because it's no longer just that, what you're going to offer is very similar to what your competitor or your neighbor or someone else like you is offering, because there's just a much wider variety of things available. It's developing very fast. So I would advise that please keep abreast with how quickly this space is shaping. It's no longer just broad market index and capturing beta or some sectors. It's now gone into slices of sectors combined with other factors, which is making it so interesting. So it's a full world of you becoming the fund manager rather than the fund manager sitting in an asset management company.
Sid, from your experience, what can distributors do to scale up their passive businesses in India?
I mean, I firstly 100% agree with what Vishal just said. Positioning yourselves as the outcome-oriented, client-centric kind of solutions providers is going to be the way to grow your businesses. What I would add to that is to very, very quickly, if you haven't done so already, start adopting technology to help you do this. Because Vishal said it, like the complexity is increasing. There are more and more tools available for you to create very, very hyper customized portfolios for your clients. It will get very hard unless you have like a tech platform that you're comfortable with that helps you analyze the requirements, what recommendations you want to make. So combining the huge array of funds, ETFs, solutions, active, passive, whatever you want to call it, that's available now, with a very, very strong technology platform is going to be the key to actually scale. Like, and scale is what is really going to win the game here.
Okay. Anirudh, I have one question for you. You said there are more than 400 indices that you've developed. How does this audience here keep itself educated about all these unique combinations which keep coming in? There is so much. It's, in fact, passive. The selling point was meant to be simplicity. But now I find that the passive category is very, very complex, because there are so many complex products which are getting launched. And you are responsible for that.
Absolutely.
Creating confusion. So earlier life was simple, nifty, 50, khatam.
No, I think we are creating things to make things much more clearer. I think one of the things that we have done, maybe for your audience, they should read this. This is Nifty Passive Insight. This is a document, monthly document that we release every month.
Okay.
That gives you as much data as we can collect from the publicly available data sources and put it into this particular
And
document.
can they get, they see a soft copy on
They can download a soft copy from our website, happy to add them into a mailing list, and this is absolutely free of cost.
Okay.
I mean, I think I 100% agree with both my panelists here. For the advisor, it all starts with knowledge. They need to really first understand and know what is available before they go and participate in the entire advisory and the planning process. And for that, we as a company, we believe that it is important for us to kind of then, provide them the tools, be the water cooler so that we can provide the relevant informations out in the market. And that's exactly what we are doing. So 2 things that we do. One, we have created a website which is called indiapassivefunds.com. That has got information about every single passive funds, every single things which is happening in the country with respect to the passive funds. Again, it's free of cost. Anybody can go and look at information from the website. And the second thing that we have started is this monthly document, again, to kind of ramp up the knowledge sharing activity from our side.
Okay. Time is up. What I'd like you to do, gentlemen, is to give this audience a couple of actionable points before we end this discussion. Start with Vishal.
I think read this book.
Read his book. Okay.
Like it's the last point. Like I think 2 things. Think about the whole portfolio rather than the next fund, and then leverage technology to really help you deliver the kind of customized insights that your clients really will need going forward.
Okay.
And I would say, knowing the customer's need is of paramount importance. So pay attention in terms of understanding your customer first, that what is the specific needs.
Yeah.
And second, of course, you need to kind of add to your knowledge base so that you can effectively engage with the customers and help them create the entire infrastructure.
Great. So, friends, I have 2 main takeaways from this discussion. With the advent of passives, your role actually becomes more important rather than less important. Earlier, you had a story to sell about performance. You no longer have that story, but you're adding more value to the clients. That's point number 1. Point number 2 is that the starting point of any asset allocation is the client himself. You don't start with a committed to passive funds or active funds. It's based largely on the needs of the client. So with that, we come to the end of this conversation. Thank you, gentlemen, for sharing your insights. That was very useful.
Sure.